Stay tuned to find out why no one's going to
drain the swamp. Oh, wrong way.
That way. Oh boy, I had to have my spokespeople. I need how these rappers have their hype man. They come out, y'all get ready for who? Those are my hype people. Those are my two hype girls. Stand by to find out why nobody is going to drain this swamp. Wolf Richter has an interesting story. And as a side note, I may get into this at the end of this video because this may be short enough to do so. Deutsche Bank tries to stay alive. Well, again, he says one of the hardest things to do is to shrink your way to profitability. So, anyways, this other article we're going to talk about to start with, why no one is going to drain this swamp. The financial sector, well, first of all, it says the financial sector threw $2 billion at Congress during the election. Biggest spenders? Not the banks. The financial sector whose products, risk-taking, and shenanigans blew up the sector and everything around it during the financial crisis, has finally gotten the memo in a serious way. During the past election cycle, 2015-2016, it doused the members of Congress with a record amount of money to, influence decision-making and get what they want. Deregulation, handouts, and, of course, subsidies. How much? Over $2 billion. That's with a B. Yes, I said billion. For certain, I'm only going to say 2 million. You'd laugh at that these days, right? That's over $3.7 million per sitting member of Congress, according to a report released today by Americans for Financial Reform. The $2 billion tab fell into two categories: campaign contributions by companies, trade associations, and individuals associated with the financial sector, $1.104 billion. This was almost twice that of any other specific business sector. Imagine that. Lobbying expenses by 460 financial sector entities, $898 million, so almost $1 billion. The financial sector is by far the worst sector, by far the largest sector, source of campaign contributions, anyways, to federal candidates and parties, and the third largest spender on lobbying. The report explains, based on data by the Center for Responsive Politics, which tracks campaign contributions reported to the Federal Elections Commission and lobbying expenditures reported to the Senate Office of Public Records. The financial sector includes commercial banks, savings and loans, credit unions, finance and credit companies, securities and investment firms, accountants, and miscellaneous finance. But actual amounts are much higher. Entities often report this data many months late. Contributions and lobbying expenses reported after February 8th are not included in the report. Oh, of course not. Financial sector, as defined by the CRP, excludes some trade associations and companies with a very substantial financial interest, such as the U.S. Chamber of Commerce, which lobbies extensively on financial issues, and the National Auto Dealers Association, which lobbies on policy regarding auto loans. Also excluded is dark money contributed to profits or nonprofits, that engage in political advocacy in their own right but do not have to report their donors. The total amount of unreported dark money spending is widely believed to be at least as great as reported spending. So the $2 billion is a minimum. The actual could be $4 billion or whatever. That is starting to be real money. The top 20 performers. Who is number one? Goldman Sachs? Wells Fargo? Nope. The National Association of Realtors. It's trying to get the government to inflate the housing market in myriad ways. For instance, by dominating the mortgage industry, including guarantees and mortgage-backed securities, thereby subsidizing mortgage rates. It's all about realtors making more money because commissions are fatter if extracted from higher home prices, right? It's like when you go out for a restaurant. You spend $10, I'm going to leave a $20 tip, 20% tip, leave $2, right? $10, 20%, $2. But if they could make your bill $20, nothing changed. I brought you the same food out, same drink, same service. $4, please. I doubled my income. I doubled my commission or tip. Same principle. And the NAR is very concerned that the government might be cracking down on pandemic money laundering in the housing sector, which I also told you about the other day from this same site, wolfstreet.com. And what I showed there was they did a pilot program and said, we think there might be some money laundering in a couple of the bigger cities in this country. So we're going to test that theory out. Sure enough, they found out about 30% of the home purchases were being used with laundered money. The program was supposed to end already, but they decided it's been working so well, they expanded it to 6 or 7 other cities. And the only comment the guy was willing to give was, it looks like we did the right thing making that move. I can't give you any numbers, can't give you any, it's too preliminary, but it looks like we did the right thing. In other words, all of the other cities that they've got, and what if they expand it to 10, 15, 20 cities? Are we going to find 30% money laundered there too? If you have tons of money, you don't care. You don't care what you pay for a house. To you, this is a physical object. It's an asset. I'd rather have my money in that because I think I know what's coming down the pike, and I've got a lot of laundered money, so I want to put it in all these different assets. So you are hugely responsible for the housing prices going way up to astronomically unaffordable levels, and with that, of course, goes rent money. Do I need to pull up Zillow right now again? I'm not going to. And show you the map of the little blue foreclosure houses and the red ones. Just houses in Florida, pretty much everywhere for sale, again, out of control. So now everyone's trying to get out of them. Anyways, the NAR gave more than twice as much as the next guy in line, namely a quaint hedge fund, Renaissance Technologies, followed by another hedge fund, Palomar Partners, followed by another hedge fund, Elliott Management, followed by the Banking Trade Association, American Bankers Association. Commercial banks are further down on the list, campaign contributions and lobbying expenses combined. National Association of Realtors at the top, $118.6 million. Renaissance, $53 million. Palomar Partners, $41 million. Elliott Management, $28 million. American Bankers, $25 million. Bloomberg LP's in there, $25 million. Soros, George Soros, Soros Fund Management, $24.6 million. Pritzker, Prudential, Securities Industry and Financial, Star Company, Stephens Group, Citadel, Wells Fargo down there, Citigroup, Hendricks, MetLife, New York Life Insurance, Goldman Sachs towards the bottom, and Investment Companies Institute as number 20. So that's the top 20. That's how much money they spend. That's how much money it costs. Lobbying expensive. This is a built-in expense on all of their balance sheets. Advertising and payroll, unforeseen. Those are second, third, and fourth. First, pay off Congress, campaign contributions, lobbying. First and foremost, line item number 1. This report lists many more entities by name, which he links here. I'll link this website. These are just the top 20. Clearly, Goldman Sachs, near the bottom of the above list, doesn't need to spend that much money on campaign contributions and lobbying. It gets what it wants by other means. For example, having its ex-executives play major roles in the administration and at the Federal Reserve. This chart of the past 9 election cycles shows how overall performance have improved over the years. So this is certainly an exciting growth sector in the U.S. economy. However crummy the rest of the economy or corporate earnings might be. It also shows how the $2 billion were divided up between campaign contributions and lobbying. So let's look at that chart. So I can make that a little bigger. And the green is campaign contributions. The poop brown color is lobbying. And you can see this is what it costs. This is a built-in expense Nowhere else where you find these kind of expenses. The company I work for, we have absolutely never will, and have not to date, had any kind of, well, we got to, maybe a little bit of advertising. Nothing, absolutely nothing for, let's pay off our senators. Let's pay off some congressmen. Maybe we can get our phone systems. My company sells business phone systems, the company I work for. Maybe we can get we can get all your phone systems replaced out at the taxpayer's dime. You don't need phones replaced at these offices because they were probably replaced last year by some other lobbying firm, paid you off to get them in there. But we're going to pay you more. So you guys need another new phone system. And they did contribute. Oh, they contributed a good amount. Let's go ahead and authorize that. That's how that works. And we don't do that. Maybe that's why we're not super billionaires where I work, Here are the top 5 recipients of said money in the Senate. Tell me if any of these names, at least I'm looking at the top 3 of the 5. Senator Marco Rubio, Republican, Florida, $8.6 million. Ted Cruz, $5.4 million. Senator Chuck E. Schumer, $5.3 million. Rob Portman, $4.1 million. And Pat Toomey, $3.9 million. And here are the top 5 recipients in the House. That was the Senate. Now we go to the House. Well, first and foremost, Paul Ryan, $5.7 million. Kevin McCarthy, $3.3 million. Patrick Murphy, $2.2 million. Joe Heck, $2.1 million. And Chris Van Hollen, $2.1 million. The financial crisis is already forgotten, except the key element for the financial sector, including the housing sector. They got bailed out by the government and to a much larger extent by the Fed, and they continue to get propped up with the still ultra-low interest rates and the Fed's gigantic pile of securities, including mortgage-backed securities, that it has acquired during the phases of quantitative easing. So it's no big deal, apparently, for these players if there is another financial crisis, but deregulation must happen. Financial reforms must be rolled back. The housing market must be subsidized more than ever. Bonuses, stock-based compensation, share repurchases, and commissions beckon. What is in reality a relatively small amount of money, just a few $billion, a pittance really, must be spent by the industry to reap the huge payoffs. As the old saw goes, you have to spend money to make money. But in the real economy, where has all the optimism suddenly gone? Speaking of some banks and whatnot, Wolf Street again, Wolf Richter. It's been a while since I've had to come out here and talk about Deutsche Bank. Walking dead man. One of the hardest things to do is shrink your way to profitability. Let me say this up front. When an at-risk, too-big-to-fail bank raises fresh capital from investors, it's a great thing for affected taxpayers. When push comes to shove, every dollar thus extracted from investors lowers the burden, or potential burden if they fail, on taxpayers. Since the financial crisis, Deutsche Bank has been raising capital in large waves, $20 billion so far. And now its new efforts to raise another $8.5 billion by selling shares would bring the total to $28.5 billion, and it would nicely dilute existing shareholders further. And it would be a great thing for affected taxpayers. Not that taxpayers would be off the hook. The assets on Deutsche Bank's opaque balance sheet equal 58% of Germany's GDP. The $8.5 billion in new capital would nevertheless lower both the risks for effective taxpayers. So I'm all for it. But I love the way they're going about doing it. It says, Deutsche Bank CEO John Krein came out this week to persuade existing shareholders, not taxpayers, that diluting their stakes by selling $8.5 billion of new shares would be a good thing for them. If they wanted to maintain their stakes, they could buy into the offer. He supported this with a new emergency turnaround plan. No one can remember how many emergency turnaround plans Deutsche Bank has been trotting out over the years, though. But nonetheless, there's another one. The new plan calls for boosting the retail business in Germany, and so it abandoned old plans to sell Postbank. It's going to compete with largely state-owned cooperative banks. It's going to be just as tough as it was before it had decided in one of its prior turnaround plans to cut its exposure to the German retail business, and it wants to strengthen its global investment bank after it had decided to shrink it in one of the prior plans. The capital raising buys them time, Moody's Peter Nerby told Reuters. You can go along with their plan point by point, and the main thing you can tick off is capital and de-risking. One of the hardest things to do is shrink your way to profitability. End quote. But maybe because throwing more money at it is better than losing what they already sunk into it, Deutsche Bank's three largest investors, who together own nearly 20%, a group of Qatari funds, the nation Qatar or Qatar, funds controlled by former Prime Minister Sheikh Hamad bin Jassim Al Thani, U.S. fund manager BlackRock, of course, and China's HNA Group, are likely to back the capital hike. People familiar with the matter said. Oh, I love those. One of the other options would be that Deutsche Bank might not make it, and their existing equity stakes would dissolve in financial smoke. The Qatari funds, which own nearly 10%, have been on board with a capital raise since October last year and had expressed their willingness to buy more shares to protect their stake if the bank were to raise more capital. In today's Reuters reported, that stance has not changed since, and an official in the Sheikh Hamad's office confirmed that the former prime minister had met with Deutsche Bank in recent weeks but declined to comment. BlackRock, which owns nearly 6% of Deutsche Bank in its funds, is, according to Reuters, likely to take up its rights, partly because many of its funds are bound to do so of the lender's stock market weighting. HNA Group, the Chinese one, a conglomerate with big interest in airlines and a passion for global acquisitions, owns 3%. It is also willing to buy more shares to protect its stake from dilution. A person familiar with its thinking told Reuters. And all this is somewhat ironic because on last year, September 26, 2016, when Deutsche Bank shares were threatening to drop in the single digits, it denied rumors that it would sell shares and dilute the already beaten up shareholders further. That question is currently not on the agenda, it said at the time. But the world changes in 5 months. Full-fledged support from the ECB, European Central Bank, jawboning from the German government, and the Qatari funds' much hyped willingness to buy more shares helped. Wall Street was looking for a buying opportunity. And of course, the outgoing U.S. administration desperately wanted to settle the residential mortgage-backed securities case. The Department of Justice had initially asked for $14 billion in fines, but then in the last days of its reign, gave Deutsche Bank a huge incentive and finally settled for about half, about $7.2 billion. All these efforts in unison bore fruit. Its shares have since soared 75% to 1794 euros, and its infamous COCO bonds, contingent convertible perpetual bonds that are designed to be bailed in case of trouble before taxpayers get to foot the bill, have regained life, with the 6% bonds jumping 30% to $95.22 on the euro. And the support from the big three shareholders has pumped up shares 2.6% today. If they had turned their backs, no telling what would have happened. That's why they practically have to tag along just to protect their investments. When prices are high, or at least off the floor, that's the time to sell shares, raise capital, and dilute shareholders, as it had been done before in 2010 and 2014, only to see its shares fall afterwards all over again to even lower lows as the nagging details of reality kept catching up with it. So, since it was down nearing $10 anyways, now it's back up to 18, 19, whoa. If they're going to get lower lows, I think the next stop, I'm not sure how long it'll take, but the next stop for Deutsche Bank will definitely be stock prices. That is, stock prices going down in single digits. $8, $6, I don't know. Because remember, if we have a stock market sell-off, even if Deutsche Bank is doing great, they got money coming out the ears, they got investment from God knows where, the God was dropped it on their heads. Here you guys go. I love you guys. You like Goldman Sachs, you're doing my work, God's work. Here's a bonus. If a stock market sell-off happens, the banks go down with it, right? Everything related goes down during a stock market decline. Bank stocks don't just go, oh, we're fine. Do you remember 2008? Do you remember those bank stocks where they went? The auto industry went down. Financial industry went up. Every industry was affected. So God help Deutsche Bank after this nice capital raising they did. We have this a little downturn, and we're facing with them, their shareholders, with single-digit stock prices. I think we both know how this is going to end.